$5 trillion times zero is zero. Meaning if you don't have velocity, you don't have an economy. This pandemic is not going away soon. And the way to understand the economy is it's a technical recession. So first quarter at negative GDP, second quarter, it's not announced yet, but it will clearly have, deeply negative GDP. You get 2 consecutive quarters of negative GDP, that's a recession. We may be out of the recession already. The third quarter may show positive growth, but that's kind of irrelevant because we're in a depression. A depression is much more profound, much more long-lasting, much more damage than a technical recession. This is a multi-year depression. It will have intergenerational effects. So this is going to take 5 years to come out of statistically, but it's going to take 30 years to come out of psychologically. It's an economic crisis, yes, but the banks haven't failed. It's just that every single small business in America has failed. That's a very different thing. We're looking at 50 million Americans who have applied for unemployment benefits. They say if with a few adjustments, not very much of a stretch, the unemployment rate is on its way to 20%, worst level since the Great Depression. So the pandemic's getting worse. It's going to last longer than people think. The economy may or may not still be in a recession, but we are in a depression that's going to last for years. And the psychological behavioral effects will be intergenerational. So this is not like 2008. It's not like the dot-com crash. It's not like 1998 with Russia and LTCM. You have to go back at least as far as the Great Depression in the 1930s and maybe back to the 1870s to find something comparable. This is why monetary policy will not work, will not yes, change the outcome, and fiscal policy will not change the outcome. Now, there are different reasons for those two conclusions, but let me start with monetary policy. They keep saying this is stimulus. The Fed cut rates, that's stimulus. The Fed's printing money, that's stimulus. They guaranteed the corporate bond market. They guaranteed the municipal bond market. They're buying mortgages. They're buying, everything in sight, and that's stimulus. Well, they are buying everything in sight or guaranteeing it. That's true, but it's not stimulus. And the reason it's not is because of velocity. Velocity is the turnover of money. So a simple way to think about nominal GDP, there are different formulas, but the easiest formula is what's the money supply and what's the velocity, the turnover of money. If you have $1 in the banking system, does it support $3 of goods and services or $1 of goods and services or $0 of goods and services? And the example I give is, I go out to dinner and I tip the bartender, and the bartender takes a taxi home and tips the taxi driver, and the taxi driver puts gas in her car. Well, in that example, my dollar has velocity of 3 because you had $3 of goods and services, the bar tab, the taxi tab, and the gasoline. But what if I stay home and watch television and leave my money in the bank? Well, that has velocity of 0 because I'm not spending it. And the point is, I always say you don't need calculus for this. Fifth grade math does fine, but $5 trillion times 0 is 0. Meaning if you don't have velocity, you don't have an economy. Inflation has nothing to do with money printing. It has everything to do with velocity, and velocity is psychological. And the Fed forgot this. I don't know if they ever knew it, but they seem to have forgotten this a long way. And changing psychology is very different than changing the printing press. And let me give you some hard numbers. Savings rate in May in the United States went to 33%. Ooh. Now, it was running about 5 or 6%, which is, not the highest, but pretty high. And when Americans are really lean and mean, they're saving 8%. They saved 33%. But think of the reasons for that. So let's say you lost your job. Well, you're definitely going to save. You got to pay the rent. You might not be able to pay the rent, but if the government gave you a stimulus check, which they did, people didn't run right out and go to dinner. They put it in the bank. Let's say you still have your job. You were not unemployed. Well, you're probably saving too, because who knows if you're next? It's just, even people who kept their jobs are worried that they'll be the next ones to get fired. And by the way, we're right now, literally as we speak, Shay, we're experiencing a second wave of layoffs, and I can explain why. Everyone's worried about the second wave of the virus, and that's a legitimate concern. But right after the pandemic hit, the shutdown hit in March, that's when, really mid-March was when the U.S. economy shut down. There were 50 million Americans who applied for unemployment benefits. In other words, they lost their jobs between March and June. So what happens if you save? What's the velocity of your money? It's zero. And so all the money printing in the world will not generate GDP if people don't spend it, and they're not spending it. So that's why monetary policy fails. Flip over to fiscal policy. There's another 5 trillion. We used to think $1 trillion was a lot of money, but now it's
5.
Yeah, those are the good old days. So we're spending 5 trillion. And everyone's like, well, that's stimulus. And I said, no, they are spending 5 trillion. Yes, they do know how to do that. But it's not stimulus, meaning you can borrow $1 and spend $1, but you only get maybe 60 cents or 70 cents of GDP. Well, now it's like borrow $1, spend $1, and get maybe 70 cents of GDP. So what happens? So what's happening to your debt to GDP ratio? Well, your debt's going up dollar for dollar, but your GDP is only going up, say, 70 cents on the dollar. So your ratio is going up even higher, making the problem even worse. And people say, well, you can't borrow your way out of a debt crisis. Well, sometimes you can, but not when your debt is this high. And so monetary policy falls down because of velocity. Fiscal policy falls down because the debt to GDP ratio is too high. And then that induces a behavioral response. People will go, well, I'm not a macroeconomist. I don't know how the U.S. is going to get out of it, but I know I'm going to have to pay. They're either going to default on the debt, raise my taxes, or cause inflation, and which is just a form of tax.
Yep.
So people say, well, look, I don't know how this is going to work out, but I know it's going to come. It's going to come on me. I'm going to have to pay. So people save more. They do the exact opposite of what the economists assume, because people have more sense than most economists. And so whether it's fear of losing your job makes you save more, or fear of inflation and taxes down the road makes you save more. Either way, you save more. Now, savings can be a good thing if you can put it into productive investment. But even then, even if you do it right, and I would say we're not doing it right, but even if you did do it right, that's a 5 to 10 year payoff. Well, 5 to 10 years is a long time when you're in a depression. Our economy runs on consumption. Consumption's at 70% of GDP. So when you substitute savings for consumption, it might have some benefits 5 years from now, but that's a really long time, and that's why I call it a depression. So there's no way out of this in the short run. So I have used the expression the reset, and others have as well. I mean, there are other books and commentators on the topic. And what I mean, and the others I refer to generally mean, is a loss of confidence in currencies, the dollar. And it's not the case that people are going to lose confidence in the dollar and the euro is going to reign supreme. They're all in the same light, but the euro, the dollar, the Aussie dollar, the Canadian dollar, they're all going to go down at once, because they're all in the same lifeboat. And you'll need to restore confidence, and the way to do that is with gold. And you're our gold expert. We can talk more about gold. But so you basically have to reset the international monetary system, and there are a number of ways to do it. And I've sketched out the different ways in my book Aftermath. So you don't have to put a stake in the ground. Here's how it's going to be done. You just say, well, here are 3 or 4 ways it might be done. But they all fall under the heading of the Great Reset. And the elites always get it wrong. Yeah. And there are reasons for that, because they all talk to each other. They need some new friends. But they're calling it the Great Reset. But what they mean is pretty much the opposite of what I just described. This is really globalization 2.0. So from 1989 to, I'll say 2008, globalization was like a runaway train. It was, highly integrated supply chains, no borders, no tariffs, outsource your stuff all over the world, and who cares where the jobs end up, put them where the cheapest labor is, and just cut costs and make profits. And it was leading to, not all at once, of course, but it was leading to global taxation, which is still on the table, thanks to our friends at the IMF and the OECD. World money, which is the IMF special drawing right, the SDR, and ultimately world government through some combination of the United Nations or, again, the IMF. That was the goal. They knew it would take, perhaps decades more to get there. Soros is behind it. Well, all the elites are. They're all in it together. But that got blown up, completely blown up because of the damage of 2008. So far, at least, this has not been a financial crisis. The banks are still standing, but it is a profound economic crisis. They're a little different because they can play out over a longer period of time, but everyone feels it and everyone knows we're in some serious difficulty. And the elites are coming back. People are fearful. They're looking for solutions. Here we are. And their great reset is globalization 2.0, moving, kind of overthrowing the nationalist trend and moving faster and closer to a one world government. So here we have the battle of the great resets. We have the Jim Rickards Great Reset and others, I should say, which is collapse of confidence in central banks, collapse of confidence in fiscal authorities and government authorities, and the need to restore confidence. And again, there are ways to do that, versus an elitist globalist theme that says, no, confidence has been destroyed, and we have the answer, which is more world government, world taxation, et cetera. So let's see who wins. It's going to be an interesting struggle.
We're clearly in a gold bull market.
Yes.
A lot of the questions I'm hearing at the conference is everybody keeps asking the same question: is it too soon? Now, I'm pretty confident I know what you're going to say. So, sorry, is it too, has it run too far, too fast? I would love to hear your take, obviously for everybody watching it, but also too for the Australian viewers. Where's gold going to from here?
Well, it's going up. It's going up a lot. And let me just back that up a little bit, because that's easy to say. I don't say things like that without a lot of analysis. There are three different ways to think about it. One is just some technical analysis. This is the third great bull market in gold in history. And when I say history, I'm only going back to 1971, because prior to 1971, gold was money. So you didn't have a bull market or a bear market. It was fixed to the dollar. The people who bang the table and say, give me a gold standard, I'm like, well, be careful what you wish for, because in a gold standard, you're not going to make any money on gold because it's fixed, it's pegged to the dollar. If you want to make money on gold, you would actually be against a gold standard, because they keep screwing up the currency and the gold goes up. But we had a bull market from 1971 to 1980, and gold went up 2,700%. Then we had a bear market from 1980 to 1999, and gold went down from $800 to $250. So that's, and do the math, that's 60 or 70%. Then we had the second great bull market from 1999 to 2011, and gold went up 670%. Then we had a bear market. It's funny how these things go in cycles, from 2011 to 2015, but you can call the bottom. It was December 16th, 2015. Gold was $1,050 an ounce. I'm talking US dollars. That was the bottom. Gold is going to the moon, but no commodity goes to the moon without a 50% retracement along the way. There comes a time when it drops 50%, and then there's like the second liftoff, and then it goes to the moon. Now, take the bottom in 1999, it was $250 an ounce. The top was $1,900 an ounce in August 2011. So that's $1,750. Half of that, so 50% retracement, would be down $825. So 1,900 minus $825 puts you at $1,075. Well, bingo, $1,050. That's close enough for government work, as we say. So when I saw $1,050, I talked to Jim Rickards about this earlier. When I saw $1,050, I said, okay, there's your 50% retracement. Using 250 you have to have a base. Using 250 as your baseline, up to 1,900, take that gap, down 50%, boom, 1,075, we were 1,050. I said, that's the low. Now it's getting close to 1,900 again. I mean, actually on an intraday basis, I think it just kind of kissed the all-time high. It was like right there. So there's the full retracement of the bear market, but this bull market, the third great bull market, started December 2015. We are up almost 90%. But when you get into like 600, 700, 800%, or 2,000%, you're talking about $15,000 by 2025. So if we just did the average of the two prior bull markets, I'm not even talking about the higher of the two. Take the two bull markets, average the duration and the gain, and then apply it to December 2015, you get to the exact number is $15,000 by 2025. $15,000 an ounce by 2025. But people go, that's 4 years away. It's like 5 years away. I was like, yeah, but to get to from 2,000 to 15,000, you got to go 3,000, 4,000, 5,000, 6,000. You can make a ton of money. So that's where it's going. Now, could it go down tomorrow? Sure. I mean, the gold's volatile. I don't get too hung up on it because I'm kind of a buy and hold person. You know, I don't get too euphoric when it goes up, but I don't get depressed when it goes down. In fact, when it goes down, I like to see it go up for our listeners and our readers. But personally, I don't mind when it goes down because you can buy more at a cheaper price because I know it's going up. I know where it's going. When you get to higher levels, a fixed dollar increase is a smaller percentage increase. So people go, oh, it went from 1,800 to 1,900. It went to 2,000, 2,100, 20, and that's a big deal and good for all of us. But those $100 increments get to be more and more frequent and more common because they start looking like 1/2 of 1%. 1/2 of 1% is not a big deal in the market. So you're going to see that on a daily basis. So my advice to people, of course, is buy gold, but then people, you know, but I said that at 1,100, 1,200, 1,300, 1,400, 1,500, 1,600. You know, I've said it all along, and people don't buy it. People also accuse me. They say, "Well, Jim, you're just talking your position. You know, you're just trying to sell gold." I'm not a dealer. I don't make any money. If you buy gold, good for you. But I'm not in the business. I'm a writer. I'm an analyst, but I'm not a gold dealer. I'm actually one of the few analysts, apart from yourself and a few others, who are not gold dealers. But I think that gives you more credibility because you're not selling gold, you're understanding gold. But for anyone who hasn't bought it yet, of course, denial is a powerful thing. They'll say, well, I missed the boat. Now it's up the side, it's going to go down. You haven't missed the boat. I mean, again, 80, 90% is a good run, but this is going to go multiples of that.